Money, some have it, some don't, some have mastered it, most are still chasing it. You may think of money as just numbers, spreadsheets, and math, an equation that needs to be solved. But the real financial decisions are made far away from calculators, around dinner tables with ego, pride, fear, and personal history. The true nature of money is the dance between the cold arithmetic of a spreadsheet and human nature. When it comes to money, we are complicated creatures, and financial success is not so much about how much you know, but how you behave. This video was inspired by Morgan Housel's amazing book, The Psychology of Money. Let's dive into the strange and human side of money, financial DNA. We all come from different generations, with parents earning different incomes and holding different values, living in various parts of the world, born into different economic environments with varying incentives and opportunities. We all have very different experiences with money. Take, for example, the stock market and inflation. People born in 1970 saw an almost tenfold increase in the SP 500 during their teens and 20s, leading most to have a positive view of the stock market and a higher inclination to invest. People born in 1950 saw the stock market go nowhere in their teens and 20s, leading to a more negative view of the stock market and less inclination to invest. People born in the 1960s experienced significant inflation during their teens and 20s, leading to greater awareness and a more negative view of inflation and its effects. People born in 1990 experienced relatively low inflation during their lifetime, leading to less concern and awareness of its effects. A person's experience with the stock market and inflation during their formative years greatly shapes their attitudes and behavior toward investing and financial decision making. People justify every financial decision they make based on the information they have at that moment and their mental model of the world, a model passed down from their parents and shaped by their unique life experiences. Although they can be misinformed, lack information, or make bad decisions, their actions make sense to them in the moment and align with their own personal story. According to Housel, people do some crazy things with money, but no one is crazy. We all have unique worldviews, and since there is no universally correct way to manage money successfully, none of us are crazy. We make financial decisions based on our personal life experiences and our worldview compound kings. There is no doubt that Warren Buffett is considered one of the greatest investors of all time. What's staggering is that $81.5 billion of Warren Buffett's $84.5 billion net worth was earned after he reached his mid-60s. Housel explains that few people pay enough attention to the simplest fact: Buffett's fortune isn't just due to being a good investor, but to being a good investor since he was literally a child. Because he started investing at the age of 10, Buffett was able to harness the power of compounding. Let's say you invest $1,000 at an interest rate of 8%. Your initial investment would earn you $80 after 1 year. If you compounded your total of $1,080 at 8% interest the next year, you'd now earn $8640. You've earned money on your initial investment as well as on the interest you earned on the principal. An investment compounded over time gains interest not only from the original investment but also from the interest generated on top of it. The counterintuitive nature of compounding makes many of us underestimate how extreme the results can be. Warren Buffett began investing seriously at age 10 and had a net worth of $1 million by age 30. Now imagine an alternate reality where Buffett behaved more like most young men in their 20s, spending a lot of his early income on travel and a few nice cars. If he'd started with a net worth of $25,000 at age 30 and retired at 60, but continued to generate his amazing average return of 22% annually, his net worth today would be around $11.9 million 9% less than his actual net worth of $84.5 billion. Warren Buffett's financial success can be attributed to the financial base he built in his early years and his longevity in investing. His skill is investing, but his secret to success is time and the power of compounding. Now consider this from another angle. The richest investor of all time is Warren Buffett. But in terms of average returns, he's not the greatest. Jim Simons, for instance, is a hedge fund manager who has compounded money at a staggering 66% annually since 1988, a much higher rate than Buffett's. Yet Simons' net worth is 21,075,000,000 less than Buffett's. Pursuing money without valuing time is like filling a bucket with a hole in it. No matter how much water you pour in, it keeps leaking out. Similarly, no matter how much money you accumulate, it won't bring lasting happiness if you don't have control over your time and can't enjoy the fruits of your labor. Tail events. Heinz Berggruen, a man who fled Nazi Germany and settled in America, became one of the most successful art dealers of all time. He collected a massive amount of art, including works by Picasso, Klee, and Matisse. In 2000, he sold part of his collection for over 100 million euros. What was his secret? Skill or luck? According to a research firm called Horizon, great art investors buy vast quantities of art and hold on to it for a long time, waiting for a few of those pieces to become famous and immensely valuable, even though most of what they bought was worth little. In other words, it's not about being right all the time. It's about having a diversified portfolio and waiting for a few winners to emerge. Perhaps 99% of the works someone like Berggren acquired turned out to be of little value. He could be wrong most of the time, but that didn't matter because the other 1% turned out to be the work of someone like Picasso. These are known as long tail events when a small number of outcomes account for the majority of the results. The long tails of Berggren's collection were what ultimately built his fortune. This long tail concept applies to many parts of business and investing. The obvious example is venture capital. Most startups in a VC fund fail and lose money, but it only takes a few outlier companies with 20x plus returns to make up for all the losses. Take Amazon. In 2018, it drove 6% of the return on the entire SP 500, even though it's just one company. Look inside Amazon, and its growth was largely driven by two tail events, Amazon Prime and Amazon Web Services. These two products alone more than made up for all of Amazon's less successful experiments, like the Fire Phone or its travel booking venture. After the disastrous release of the Fire Phone, rather than apologizing to shareholders, Jeff Bezos said, "If you think that's a big failure, we're working on much bigger failures right now. I am not kidding. Some of them are going to make the Fire Phone look like a tiny little blip." Bezos understands that it's okay to fail with most products if the process eventually produces the 1% of tail event products that drive everything. Tail events are mostly hidden from us because we only see finished products, not all the failures behind them. Housel uses the example of a stand-up comedian. When you watch a Netflix special, you think, wow, this comedian is amazing. What you don't see are all the failed jokes tried out in small clubs across the country before that special. The special is the 1% compilation of jokes that actually landed. The other 99% were probably just okay. When it comes to investing, even though long tails are prevalent, most of us ignore them, and when things go wrong, we tend to overreact. Once you accept that tails drive everything in business, investing, and finance, you realize that lots of things going wrong, failing, or falling apart doesn't mean the overall bet won't work out. Out of the nearly 500 stocks Warren Buffett has picked, only 10 have made the majority of his money. Good stock pickers are only right about half the time. Good leaders only make good decisions about half the time. Being wrong sometimes doesn't mean things won't work out over time. In the end, the outcome can be determined by just a small number of events. True wealth versus being rich. It's important to understand the difference between being rich and being wealthy. Richness is about your current income and the things you own. Wealth is about the financial assets you have yet to spend. True wealth isn't what you see, it's what you don't see. It's easy to assume someone driving a Lamborghini is wealthy, but appearances can be deceiving. Many people are living beyond their means, relying on debt to fund flashy lifestyles. Wealth isn't about the cars you drive, the diamond rings, or the homes you own. It's about the financial assets you haven't spent. Building wealth takes self-control and restraint. The diamonds, watches, and first-class upgrades you decline all add to your overall wealth. It's easy to find rich role models who spend lavishly, but true wealth is hidden and therefore harder to imitate. We're conditioned to believe that having money means spending it, but the real key to building wealth is saving and investing what you have. In fact, the only way to become wealthy is to not spend the money you already have. The next time you see someone driving a fancy car or living in a big house, remember you can't judge wealth by appearances alone. The true key to wealth is self control, restraint, and building assets for the future. How is this possible? According to Housel, it's because Simons didn't find his stride in investing until he was 50 years old, giving him less than half as many years to compound as Buffett. Housel estimates that if Simons had invested over as long a time frame as Buffett, his net worth today would be roughly 63.9 quintillion. It's important not to underestimate the power of compounding. No matter how counterintuitive the results may seem, they should never be ignored. Pessimism and money. Optimism is the belief that the odds of a good outcome are in your favor over time, even if there are setbacks along the way. But when it comes to money, we all carry a bias toward pessimism. Looking back, though, things have generally improved over the years. So why are we inclined to embrace pessimism rather than optimism? The answer: good things take time and they don't happen overnight. Money is a subject that attracts pessimism for a variety of reasons. For one, money matters to all of us. When we hear about something bad happening in the economy, we're more likely to pay attention. A 40% decline in the stock market over 6 months is likely to attract attention immediately and may even trigger government intervention. But the incremental nature of a 140% gain over 6 years can go largely unnoticed. Every year, 500,000 American lives are saved by the progress of medicine over the last 50 years. Slow progress, however, attracts less attention than quick, sudden losses like terrorism, plane crashes, and natural disasters. There are many overnight tragedies, but few overnight miracles. We don't have to be pessimistic to be practical. Despite setbacks, we can hold on to the belief that over time the odds of a positive outcome are in our favor. When watching the news highlight a stock market crash or economic woes, try to remember that things tend to improve over time. Two forgotten elements. In 1968, there were roughly 300 million high school age people in the world. Kent could very well have been one of the founders of Microsoft alongside Gates and Allen. But that would never happen. A mountaineering accident took Kent's life before he graduated high school. The odds of a high school student being killed in a mountaineering accident are also around 1 in a million. Just as an extremely rare stroke of luck propelled Bill Gates and Paul Allen to great success, Kent Evans experienced an extremely rare encounter with what Housel calls luck's close sibling, risk. Luck and risk are like the wind and the waves that determine the course of a sailboat. The sailor can control the rudder and the sails, but ultimately the direction and speed of the boat are shaped by forces that can't be fully predicted or controlled. The pursuit of success is full of twists and turns, and remembering the role luck and risk play in shaping our lives can bring humility and perspective to our own financial decisions. The key to happiness. People want to become wealthier to make themselves happier, but according to Housel, the key to happiness is the ability to do what you want, when you want, with who you want, for as long as you want. The pursuit of material wealth has led many people to work harder and give up more control over their time despite being richer than ever before. Yet studies show that having control over your life is the most dependable predictor of well-being, more than salary, house size, or career prestige. Ultimately, controlling your time is the highest dividend money pays. The diamonds, watches, and first-class upgrades you decline all add to your overall wealth. It's easy to find rich role models who spend lavishly, but true wealth is hidden and therefore harder to imitate. We're conditioned to believe that having money means spending it, but the real key to building wealth is saving and investing what you have. In fact, the only way to become wealthy is to not spend the money you already have. The next time you see someone driving a fancy car or living in a big house, remember, you can't judge wealth by appearances alone. The true key to wealth is self-control, restraint, and building assets for the future. The real price. Imagine climbing a mountain with the goal of reaching the peak to admire the view. Maybe you'll get sunshine that day, maybe rain. You might get lost or fall and injure yourself. The difficulty of the climb isn't always apparent until you're in the thick of it. From the ground, the path up may seem obvious, but along the way, you'll need to reassess and adjust your route. You know going in that there's no golden escalator that will safely carry you to the peak. The uncertainty and risk are simply the price you pay to get there. But when it comes to investing in the stock market, many people think they can avoid the uncertainty and risk and get something for nothing. Housel compares the stock market to buying a car. You have three options: buy a new car, buy a used one, or steal one. The new car costs more, but the reward is greater. Think of it like aiming for 12% returns from the stock market. The used car is cheaper but comes with less reward, like a much safer investment that only returns 4% a year. Stealing a car is like trying to get something for nothing. 99% of people would avoid stealing a car because the consequences outweigh the benefits. Yet, when it comes to the stock market, people seem to believe they can take option 3 and steal from the market, trying all kinds of tricks to get good returns without paying the price, like selling right before a dip or buying right before a boom. Consider wanting to earn an 11% annual return over 30 years for retirement. From 1950 to 2019, the Dow Jones Industrial Average returned about 11% per year on average. But over those 69 years, there were plenty of highs and lows. For many people, watching their investments swing up and down is stressful, so they try to get in and out quickly, avoiding the price of volatility and uncertainty over the long term, much like trying to steal the car. The price you pay when investing isn't just about dollars and cents. It's about accepting the emotions that volatility, fear, and risk bring. Recognizing that successful investing comes with a price is crucial. That price isn't always obvious, but you have to pay it just like you would for any other product. The key is convincing yourself the market's fee is worth it, an admission fee worth paying. There's no guarantee it will be, but if you see it as a fine instead, you'll never enjoy the experience. Once you find it worthwhile, be willing to pay the price. Hedonic treadmills, enough. Know when enough is enough. Get familiar with the concept of hedonic adaptation or the hedonic treadmill. Every time you hit a goal, you move the goalpost further ahead. Look no further than the downfall of Bernie Madoff and Rajat Gupta, two men who already had everything and were ultra wealthy, yet all the money in the world was never enough. Both resorted to crime to chase even more. Pursuing wealth and success without knowing when enough is like climbing a never-ending ladder. No matter how high you climb, there's always another rung to reach for, and the pursuit can become all-consuming, leaving little room for real happiness and fulfillment.